Welcome, ladies and gentlemen, to another edition of Accounting 101 made simple by J. Ham. Today's topics discussed. Lesson number 9 will be shareholders' equity on the balance sheet, part 1, outstanding shares and additional paid-in capital, or APIC. Outstanding shares. When a company needs to raise money, it will sell a piece of itself in the form of shares of stock to its investors. Shares outstanding represents a company's stock currently held by all of its shareholders, including restricted shares owned by the company's officers and insiders, but excluding treasury stock, which is stock that the company buys back from its shareholders. There are two main types of company stock, common and preferred. Preferred stock gives no voting rights, which is the right to vote at company meetings, to shareholders, while common stock does. In the event of company liquidation, which is the sale of a company, preferred stock has their stockholders get paid first. Common stockholders get paid their dividends only after the preferred shareholders. For an example, ABC Corporation issued 100,000 shares of its common stock to investor number 1 and 250,000 shares of its common stock to investor number 2. The company's outstanding shares are therefore $350,000, which is the 250,000 shares from investor 2 and the 100,000 shares from investor number 1. And please keep in mind that any stock held in treasury, any type of treasury stock, is reduced from the total shares outstanding. And the reason why is because it's in the corporation's possession. It's therefore a contra equity account. So you have to back it out of the total shares outstanding. Additional paid-in capital, or APIC. APIC is the amount of money that a company's shareholders pay for shares of stock in excess of the par value of the shares. The par value of the shares represents the nominal value of share of stock set forth by the corporation's charter. So basically, the par value of any stock trading on Wall Street is a pie-in-the-sky number that's made up by the corporation. But additional paid-in capital, or APIC, represents the amount over the par value that investors are willing to pay for the share of stock. For an example, ABC Corporation issued 100,000 shares of its $1 par common stock to investors for $1 million. In this case, the par value is $100,000, which is the 100,000 shares multiplied by the $1 par value per share. Now we need to determine the amount in excess of that par value. And the way we do that is we take all of the money that we collected from the issuance of the shares of stock, which is $1 million, and then we subtract from that amount the total par value, in this case $100,000. So the APIC in this example would be $900,000. It's the $1 million cash received minus the par value of $100,000. APIC is therefore $900,000. Problem time. Question number 1. ABC Corporation issued 100,000 common shares to EDF investor and issued $100,000 additional shares to GHI investor. ABC Corporation has 20,000 common stock shares that are held in treasury. How many shares are outstanding? So in order to determine the shares outstanding, we have to add all of the shares that were issued to shareholders. In this case, it's the 100 plus the 100,000, which is 200,000 shares. We're not finished yet, because there's additional facts surrounding the question, and those facts are ABC Corporation issued 20,000, has 20,000 shares that are held in treasury. So we need to subtract that 20,000 shares that are held in treasury from the 200,000 total outstanding to come up with 180,000 shares outstanding, which is answer D. I put as a side note, remember you have to subtract the treasury shares from the total shares outstanding. Question 2. Voting rights is a characteristic of which of the following types of shareholders? A. Preferred shareholders. B. Both common and preferred shareholders. C. Neither common nor preferred shareholders. Or D. Common shareholders. As we discussed in the video lesson, only common shareholders have voting rights. So that's a benefit of being a common shareholder, is that you have the right to vote at company meetings. Question number 3. ABC Corporation issued 150,000 of its $1 par value common stock shares to investors on January 20th. On that day, the stock price was trading at $20 per share. How much money would ABC Corporation have in its common stock and additional paid-in capital accounts stemming from this transaction? So because we can't do a process of elimination to determine the correct answer, we then have to use alternative measures such as calculations. So let's look at the facts. When you're taking a question that contains a paragraph, like these paragraph questions, always look at the last sentence of the paragraph. And the last sentence of the paragraph states, how much money would ABC Corporation have in its common stock and additional paid-in capital accounts stemming from this transaction? So we have to take the 150,000 shares that ABC issued and multiply it by $1 to come up with the total par value of the transaction. Now that we have the total par value of the transaction, which is $150,000, we need to determine what was the total sales price of the issuance of the shares of stock. And the way we do that is we take the market price for that day, which is $20. It was trading at $20 per share on January 20th, and we multiply by the 150,000 shares. So if we take 150,000 shares and we multiply by $20 per share, we come up with an amount of $3 million. So $3 million is the total amount, the total value of the transaction from the issuance of the shares. So we take that $3 million, and then now we have to back out the par value in order to determine what the additional paid-in capital amount is. So if we take $3 million and we subtract $150 from that amount, we come up with $2,850,000. So the answer to the question would be D, $150,000 in common stock and $2.85 million in additional paid-in capital. Let's take a look at the calculation. First, you calculate the total sales price, as I mentioned. You take the $20 per share, multiply it by 150,000 shares. That's equivalent to $3 million. Second, you calculate the par value by taking the 150,000 shares and multiplying it by $1 per par value, right? Which is $150,000. Then you net the two. So the third and final step is you subtract the par value from the sales price. So if we do that, we have $3 million, subtract out $150,000, and we're left with $2,850,000, which represents the excess over par or the APIC or the additional paid-in capital. So answer D is the correct answer. In the next video lesson, number 10, we will be covering the following topic: Shareholders' Equity on the Balance Sheet, Part 2, Retained Earnings and Treasury Stock. Ladies and gentlemen, if you like my work, please hit the like button on this video. Please subscribe to this channel. Please share this video on all your social media, and please sign up to become a Patreon member. May God bless you, and see you in the next video.